What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is December 11th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, we're going to be spending some time to focus in on commodities, and more specifically, precious metals. And I want to talk about not only why I'm a macro trader and what a macro trader is, but also talk about the objectives of focusing in on commodity markets. What's the time frame we're looking at? All kinds of things of that sort. We're going to be talking about all that and more, guys, just in a moment, right after our quick sponsor. Our sponsor for today's episode is DNA. Dual Chain Network Architecture, or DNA, is a next-generation blockchain incorporating the 5 pillars of public chains: identity, security, oracles, scalability, and interoperability. DNA is built as a scalability solution running parallel to the Metaverse ETP chain, which launched back in February of 2017. DNA will facilitate extremely high transactions per second in Lightning channels, making use of pre-existing relationships between nodes. DNA has also launched its community bounty, giving out $12,000 worth of prizes and DNA tokens. To learn more, check out the link down below in the description. Alrighty, so let's go ahead and dive into this video, and I want to start off with a very interesting chart here. This is the commodities to equity ratio chart. This has been one that's been making the rounds through a lot of different kind of news outlets and a lot of different data sites that I keep up with personally. And this is one that has been posted by a company called LMTR. And it utilizes a combination, it's a ratio in this case, between two indices, okay? So to be specific, these indices are basically, these two indexes in this case are measurements of performance in two separate markets between commodities and equities, okay? So the first one here is the S&P GSCI Total Return CMEs. This is basically basketing a wide range of commodities together into a performance indice. So to see generally, you know, if the ratio is high up here compared to the second value, which is the S&P 500, this means that commodities are doing great. This is usually when oil is rallying. This is when gold and silver are doing very well. This is when a lot of industrial commodities as well are doing good, like copper and platinum and all these different things that you might not think about in silver, right? And then down at these periods down here, these are periods where equities are usually much better performers. They have outpaced commodities. Commodities have sold off. The economy is usually strong in some sort. You can see here down during the tech bust, this is when stocks were rallying to their all-time highs. And back here as well, during 2008, as equities started to sell off, commodities were rallying to extremely high levels, right? As we started to see a sell-off in stocks due to the scares in the property market and all kinds of things like that, right? And then you had peak oil. You had a big concern that oil prices were going to remain over $100 a barrel forever, right? So you see these dramatic swings that happen over time. And I want to go ahead and talk a little bit about this chart. Let's just go ahead, and I want to ask you one question here. At this moment in time, when you look at this chart, take away any personal biases you might have, take away my personal opinion that you guys might know about. Just look at this chart here. As a trader, your objective is to take basically any opportunities, or the best opportunity you find that has a favorable risk to reward ratio, right? That's the simple objective. Do you think from this chart, you would think there's a better risk to reward ratio for investing in commodities or investing in equities? Well, I can tell you guys, just to be completely fair, and this, again, it's not financial advice, it's just my view, I would see that there is an overwhelmingly more beneficial risk to reward ratio for investing in commodities at this current level, down here where we are in 2019, stepping into 2020, than investing in equities, right? And I'll put it another way. Right? Let's go ahead and take this in another perspective. We talked the other day about another chart that LMTR shared. And this is basically showing the expansions, right? These darker blue areas, and also the recessions that we've had in the past for equity markets, or basically the previous performing indices and stuff like the Dow Jones, things of that sort, right? So we can see here, if we take a look at history, right? It wouldn't really matter, you know, if we're using the Dow Jones or the S&P 500, one of these major indices that have been around for over 100 years. The question is there any time in history where we have seen an expansion like what we've seen so far, right? We're up 363% over 10.7 years here in the current expansion since we've recovered since 2008. And as we take a look across the chart here, this has been one of the best performing ones, not to mention it's been the longest expansion in history without a recession. So is there any kind of period of time here where we've seen a greater expansion? Well, there was. It was back here during an 8-year period, which was the Roaring 20s of 369%. So when we look at this chart here, we're currently sitting up here at this range here, right at the peak of this, the longest expansion in history, one that is right next to the performance of the Roaring 20s, where central banks were injecting a ton of money and doing all kinds of funny things to prop up equities. And there was all kinds of rules and regulations that basically allowed you to over-collateralize. You could use basically your stocks, your investments, to basically get access to more credit and then eventually go out and buy more stocks. So the question is here, is there anywhere in history that showcases us that we have a better room for expansion here, that we could go higher? Not much. In fact, it's almost a sign that we've repeated history, that the fundamentals may be flawed, that central banks and governments have gotten too enlarged within the economy. They've started to interfere with sound money and started to interfere with sound economics, right? And it's the reason why there's such a divergence in our economy. If you take a look at the inequality of wealth, it's the exact same as we saw in the 1920s, because we've created funny money. It's a factor that we have completely distorted base economic theories by having central banks interfering in the economy, right? So we're repeating history here, and there's not many periods of history. I'm just going to keep it simple here, that we've seen better performance than this, right? So again, going back to that same question I asked earlier, as an investor in equities, would you feel right now comfortable entering into the market, right? It may have performed great over the last week, heck, maybe even over the last month or year. But according to the last 100 years, more than 100 years of performance, would you feel safe buying at these ranges? I personally do not. Right? I invested in equities through a ton of this bull market. I was bullish throughout most of the way. I knew that the fundamentals were flawed, and I still invested in it because I knew the game theory was there. If central banks were going to continue injecting money, I was going to go long on it, right? But my risk to reward ratio is not favorable up here. I'm a macro trader. I trade for the longer term movements. I trade for these cycles because it's a very easy 300%, as we can see here, when central banks are interfering with the economy, right? So we've seen many times in the past, whether it's 100%, 200%, 300%, right? We don't want to bet against the rally. But when it gets to a point where the rally historically is overextended, the risk is not worth the potential reward. And that's the general key here, right? We want to take a look at these different cycles between commodities, between equities, right? Our goal as a macro trader, or as macro traders, if you guys would like to join in this journey with me, is to basically trade these longer term cycles, to not stress, to not day trade, to not try to predict where price is going today or tomorrow. It's to focus on a multi-month or multi-year trend, sometimes even upwards to 8 years or 10 years, up to an entire decade. And that's sometimes the cost of patience that you have to apply to get these kind of returns without having to deal with the stress, right? So let's go ahead and actually talk a little bit real time. I want to go ahead and pull up a little bit of a very simple chart here. This is silver's price here. Now I'll go ahead and turn off all the drawings here. This is the base performance of silver since back here in September, give or take, of 1997, upwards to here in February of February, I'm like jumping ahead here, sorry, November and December of 2019. God, I can't believe I'm leapfrogging into 2020 already. But I'm excited for the new year, I will say that. So we've got a lot of interesting price here to work with, right? A long period of time for silver. We can see here that back here during the early 2000s, we started to build up and build into the cycle where we peaked out at $50 an ounce for silver. And now we're sitting at a very different price, around $16.64. So how would I go about analyzing silver here, right? Well, there's three things that I keep intact with when I analyze markets from a macro trading perspective. I look for fundamentals, I look for technical indicators, and I also look for analysis and price. Okay, so we're going to go ahead one by one and talk about those things. Well, let's go ahead and talk about the fundamentals here. We've already discussed how we personally believe that through central bank monetary policy, through government intervention in the economy, there has been a mass dilution of the base value of each given dollar. And the dollar has actually been a relatively strong currency. But you can actually see this if you take a look at gold and a variety of other currencies across the world, and silver as well, from the Australian dollar to the Japanese yen, currencies that have lost value to the dollar. You actually see that gold has served as a hedge already for them. They've already reached back to their all-time highs in those other currencies. The dollar, however, has remained a strong currency in the world stage, which can distort some people's views. In reality, though, the dollar has lost purchasing power, right? It has lost its value over time. And that has been due to central bank policy. It's been done by governments in this case. And it's also been done by commercial banks through fractional reserve lending, all kinds of things like that. The immense amount of credit creation in the economy, where a dollar just simply doesn't buy what it used to, right? And we can see here, this is a really good visualization. Since back here in 2008, where we had about $7 trillion of assets owned by central banks, they have injected $12 trillion into the economy, purchasing up treasuries, government bonds, mortgage-backed securities, you name it. Central banks buy a lot of different things. In some cases, like Japan, buying up equities. So stimulating those asset markets. Again, doing all kinds of things to artificially make it feel as if things are okay, right? So that's the idea here. We know fundamentally the system is flawed. And we know that it tends to be about every 8 to 10 years. We're actually kind of pushing that tail end, being, I think it was around 10.7, sorry. 10.7 years since we've had a recession. We're getting towards the tail end here, right? At least according to history. So we understand the fundamental narrative is there. That hedging commodities like silver, like gold, whatever it may be, is likely going to go up in this period of time. We know that the commodities in general are cheap. We know that equities are overextended. So what can we expect? Okay. Well, we know the fundamental narratives there. That's one check we've already got. But we need to check off the other two areas, which are technical and also price analysis, okay? So let's go ahead and take a look here at price. Well, there's a few key things that I want to focus on. Don't worry about this right side of the chart just yet. We'll take a look at it in just a moment. But if we take a look down here, we can see here that there's a very few key set of principles that silver has actually been playing out so far. And that is previous resistance becomes support. All right? So we can see down here, if we take a look at this chart, we can see that back in the previous cycle, many times silver hit resistance here back in 2006, 2007, and back here 2009 before it led up to its rally. And this consistent resistance held down price many occurrences. We had a few breakthroughs and eventually broke through for the greater cycle, but you could see this was a significant level. And notice how this time around, after we've had a near 70% correction from the highs, we're coming back down and building support multiple times here on previous resistance. And this is a principle that's very important to understand, and that is that previous resistance tends to become new support. For those of you guys who are long-term viewers of the channel, you've probably heard me beat that point like a dead horse, right? It's basically one of the key principles of price analysis, keeping things simple. Along with that as well, we can see here another example of turning resistance into support. Right? Go ahead and turn off my drawings. You can see that I had that descending parabolic line of resistance here. And now as the line had come through, right, we can see that price is starting to rest on top of that. That's the objective here. We want to see us make support on that and then move higher. Okay. Now, the other thing as well is we want to take a look in the sense of trying to get an understanding of where we might go in this next cycle, right? What's a reasonable kind of range and time frame we should look at? How much time did it take in the previous cycle, and what kind of returns did we get? Well, we not only came down here from $4 up here to $50, but it was an 1,100% return, and it was over about 113 months. So we're talking about a multi-year time frame here, guys. That's a very key thing to take away, right? Almost up. In this case, if we're talking about 12 months in a year, we're talking this is more than a decade-long move, right? So it's very important to understand that we're working with much larger time frames. Now, I've added that same time frame here. And I've also taken the price action that we've had here. This is a really cool tool you can use in TradingView. All right, this is the date and price range. So that's that box that I have. And you can also use bar patterns, right, where you can basically scan over a certain price range or a certain time frame. And you can basically copy the price action. Now, what I've done here is I've basically built one from here, right? This is where we generally set the bottom here around 1650. And I've drawn it here within this time frame, but I've actually shrunk it a little bit. Now, the reason I do this is because there's two things to keep in mind. First off, with most new cycles, there's diminishing returns, especially if you've set higher lows here over time. And the second thing is that we chase big evens as humans. It's just very true with markets. We went up here to about $50 in the last cycle. That was the big even that people were eyeing here for silver and why we hit resistance. And this time around, a very reasonable level would be something like $100, a 2x, all the way here over more than a decade. Or maybe, and we'll talk about the time from here in a moment. Whether it's a decade or a decade and a half, to think that we could double from this level with all the inflation, with all the central bank policy, that's completely reasonable. That's not far-fetched. And from there, it's actually a lower return than what we got back here from 2001 to here in 2011. Okay? So I want to go ahead and talk here, Ben, about this line here. This is the last portion here, and also the box chart. There is no guarantee that in this cycle, we are going to have to wait 113 months to get to the all-time highs or new all-time highs of silver to finish out the cycle. And it may be that it's more than 113 months. That's another thing to factor. So this line here in this box is just to give us an open time frame of accepting that we're at least willing to wait this long. We're understanding that if we can remain patient, we can make a 611% return here over the next coming years. It could be greater, could be less, right? That's our general kind of target here, at least according to history, right? And that's the major thing to think about, that just to kind of put into visualization that we're waiting for much longer term cycles, guys. Now, I'll be honest with you, I'm even someone who's very conservative. I think that this is going to be much shorter term, and I think we're going to start moving much quicker, right? There's a lot of things that could put that pressure. We may even go past $100, but I'm keeping my estimates conservative, right? That's the objective here, is to not get too eagerly bullish. Be conservative with your estimates, right? And the cool thing about this is that we can see here as well, if we were to get back up above this range here, the next objective for price, again going towards price analysis, is to see us get above this resistance, right? Because once we get above the resistance, we start moving. And in some cases, we'll come back down and build support. Ironically enough, the previous price action kind of aligns here with how we have it drawn on our chart, where we might come up here, make support on resistance, as we did over here from over here, right? And then we move higher. That's usually a very good technical sign of price action, or a good analysis of price in this case when you're considering macro trading. Now, the third thing we haven't talked about is talking about our technical indicators. And it depends on who you are as a trader, and it depends on how you like to trade. But for commodities like silver and gold, I usually like to use the monthly time frame for when we're analyzing price, which is what we're using right now. And let me go ahead and adjust the chart. Sorry about that, guys. So I not only like to use the monthly time frame, but I also like to use a 3 set of indicators that I personally like: the squeeze momentum indicator, the MACD, and the stochastic RSI. And the general thing that I look for is I want to see higher levels. So go ahead here to the bottom here, which actually all 3 indicators checked out. I like to see a rising level here, whether it's green or red, in the squeeze momentum indicator, so a higher level per candle. Along with that as well, I like to see across the MACD and the divergence in this case, basically shrinking or growing in this case, shrinking from the downside and going to the upside. And along with that, with both lines being here in the purple channel. And notice how all 3 of those indicators checked off down here towards the bottom here. Even when the market was slightly declining, it still gave us those early warning signs that something big was coming. And we're seeing the same exact things here with silver, right? At this period of time, back here during the lows in December of 2018, it may not even look very good. If you just were to take off all the price analysis, how would you, feel confident here? Well, all the technical indicators started to signal that. We started to see a rise here. We started to see across the MACD. We started to see the stochastic RSI popping up, right? And this is on the monthly chart, right? So the thing to keep in mind here is, again, they're not foolproof, right? These are not foolproof indicators, but when they're in conjunction with the fundamentals, when they're in conjunction with the price action, with the consistent support range, it starts to become very clear that something is around the corner, right? Something is going to give in price because you have all 3 of those areas checking off. This isn't just me doing technical analysis or price analysis or me just saying, oh, the central banks are so evil, right? I start to see that price is sending a message in relation, as well as with the technical indicators, to those fundamentals that something bad is happening. Something is going to give in price. And that means that when the price starts moving, I should start to prepare myself as a trader. That's why the combination of the 3 works so well. They work in tandem. And Again, this is not foolproof, guys, but it's just a perspective. It's just a way to kind of analyze markets in a much smarter way than just saying, hey, I'm just going to buy silver, gold, and have at it and see what happens. Or, I'm not going to touch them because, oh, it's corrected so much and, equities are performing, so I'm just going to go put my money in equity markets and hold it for the next decade. Those two positions probably won't pay off very well because even if you time the market good with gold or silver, right? Let's say you were absolutely right buying at these levels here, the current level at 1669, and let's say for the next decade or two you hold it, there are going to be movements where it goes through those parabolic cycles, but it's also going to have stark 70% corrections. Key thing to take in mind here, we'll go ahead and I'll draw it on the chart. You can see here, during this time period, we had about a 70% correction here. Do you want to give up 70% of your gains? I don't. And this is the thing about macro trading that I always drill to people. It's that no matter how advanced you are as a trader in this case, you're never going to have to be as skillful as a profitable day trader, which is so rare in that case, to be able to make these kind of returns on a decade basis of 500 to 1,000%, really 5 or 10xing your money. That's fantastic. Most people will never see that kind of return on an investment in their lifetime. And if you can have those returns, lock in profits, and either move to another market or remain patient for the next kind of 5 to 10x move, then you can go for a point where if you were able to 10x your money in a decade, and then the next decade you're able to 10x it, that's 100x from your original capital. That is the kind of philosophy of the macro trader. You keep things simple. You keep it stress-free. You take a look at all the facets of what makes up these cycles, from the fundamentals to the price action to the technicals, and then keeping in mind that you don't have to stress about it every day, right? That's the general philosophy. Now, I know there's a lot of things we didn't get to talk about today, guys, about, taking profits, right? Or also just kind of having some sense of strategy to close out of positions. Right? We talked about kind of entry in this case. When all three of the boxes check off, we go towards trading. And then I would say that the opposite in this case, I'll kind of summarize it here. For closing positions, right? In this example, you might believe that it could go to a higher level than 100, right? You might believe that this could go higher. And again, I'm just in my model here. This is a guesstimate, right? This is when I would start to consider maybe taking partial profits for me. But the thing to keep in mind is that it's the opposite when you're starting to plan to sell. You should start to maybe feel a little bit bearish or maybe start taking in some profits when the fundamentals are, over-exacerbated in this case, right? When, for example, silver in this case, or these hedging commodities, are way overextended. They're starting to move in parabolic nature in the sense of price. The indicators are showcasing, like they did back here, that they were overextended on a multi-month basis. The divergence on the MACD here, take a look at how large it was. It was a historical high for multiple decades, right? And not to mention as well the squeeze momentum indicator. When your technical indicators, when the price and when the fundamentals are over-exacerbated, it's time to start potentially taking profit. That's the general idea, the general philosophy. Anyways, I hope you all enjoyed this video. I know I kind of ranted and raved on today, but if you liked it, drop a like. And if you learned something from it, leave a comment down below. But these are the kind of videos I love talking about, guys. This is how I trade. This is why I stay vigilant in the positions that I do, because I've seen historically that if you factor all these things in, you're much better walking into it than randomly investing or trying to trade in these markets. All right. Anyways, I hope you all are having a fantastic day wherever you are. As I mentioned, if you could, drop a like in the video if you liked it, and leave a comment down below if you have a question of any sort, and I'd be happy to try to answer it to the best of my ability. All right. Hope you guys are having a great day wherever you are, and I'll see you all in the next one. Stay tuned.